Welcome back. I will now focus first on the theory of DCF, discounted cash flows. I know that you already covered this in a corporate finance lecture before. So I will mostly focus on aspects which are usually not covered in academic textbooks or academic courses. Mainly focused on the different components of value and the adjustments needed. And next week we will even go deeper into various adjustments. Now let me look into the different components of value and again remind us about the free cash flows. As discussed before, in terms of our analysis, we have now discussed the money that comes out of a business in terms of its operations, which we call the NOPLAT, or the net operating profit less adjusted taxes. Now this gives us a useful measure to understand operations. Again, as we discussed, we remove any non-recurring items, we remove any financial items, and we account and adjust for taxation. Then we derived the invested capital, or to put it differently, the money I need to run the business. Now the free cash flow, so the cash flow available for distribution to shareholders and debt holders, is then the combination of the money you make minus the change in invested capital. Now the next step we have to do is we have to try to forecast these free cash flows, and we talk about this in more detail. And we have to do some discounting because we have to adjust, of course, for the value of time. Now the discount factor we use is the cost of capital, or the weighted average cost of capital. And we will explore this further in the next weeks, because there are certain issues there that need to be discussed, including taxation effects and the choice we have regarding capital structure. Now when we look a bit more closely into the different components of a DCF valuation, the main focus, also from an academic textbook, is on the so-called operating value. Now in this example, I just put it at 1,500. Now the operating value is the value of your operations. So this is derived from your free cash flows. And this would be then your forecasted free cash flows going forward, discounted back to today, using as a discount rate the cost of capital. And then you have lots of additional little buckets here that also add value. And these are very often overlooked. So when you read standard academic textbooks, they don't talk much about, for instance, excess cash. If you remember, we used the rule, which is maybe a crude rule, of using 2% of revenue to assess operating cash. Now, if a company has cash holdings in excess of operating cash, you have an excess cash position. So put differently, this additional money sitting there on a bank account is not really adding anything to the business. It's just sitting there. So the value of this cash is simply, well, the value of the cash. It doesn't add anything. It doesn't have any multiplier. So in this particular case, what we do is we add excess cash to our operating value. So the operating value comes out of our DCF model. We then add excess cash on top. Then you might have some additional investments into non-consolidated subsidiaries. Now, what does that really mean? Now, we mentioned this briefly before. If you have a subsidiary, so another company you control or partly control, it depends on how much you own. Yes, if you own 50% and more of the shares, you consolidate that subsidiary on your balance sheet. And then, of course, you have a minority interest on your balance sheet as well. And you might need, of course, to consider this in the income statement. Now, if you have a minority stake in a business, say a 5% stake in a business, this would be simply seen as an equity investment. This is not really part of your core operations. It wouldn't be part of the calculation of the free cash flows. So it would be just assessed as a separate item and valued separately. And in this particular example, this would come to 50. And then you have other non-operating assets. So this could be a whole range of things. For instance, assets linked to discontinued operations. Yeah. So, for instance, you made the decision to shut down production in a factory. The factory is still standing there. Or you divest from a city. You shut down operations there, but you still have a retail outlet sitting there but not used. Yeah, so as an example, so these items there would be accounted for. And then you obtain out of that the total enterprise value. Yeah, so that is basically how we build up enterprise value. And again, to remind you, the DCF component is only this component here. Yeah, the additional things we have to adjust for. And then, of course, it depends now how we distribute that value. And again, I stress the distribution does not enhance value. This is just a myth. It doesn't do anything to value. This is an issue about distributing it to different stakeholders. Now, of course, we have maybe debt. Yeah, so this is short and long-term debt, which would be deducted. And this comes from your balance sheet. Then you might have some stock options. Yeah, so stock options are given to executives to enhance their performance for the purpose of alignment. So this goes back to agency theory. And these stock options, of course, can be valued. And I don't want to go into the details of valuation, but there are valuation methods that are used to value these stocks. And they have to be accounted for because they are a liability for the company. Again, this is very often overlooked, but these stock options can be quite significant. Now, over time, of course, the significance has dropped quite substantially. Then, of course, we have pension liabilities. Now, this is another important aspect, and we look a little bit more carefully into it, and that's an issue depending on the type of pension plan you offer. If you have a defined benefit plan where the benefits are guaranteed, there could be the case that your liability is more significant compared to the assets that are used to support the pension plan. In this case, the liability would be seen as a debt equivalent, and it has to be accounted for. Then you might have some preferred equity. Preferred equity sounds a bit funny, but why is it preferred? So preferred equity is somewhere in between debt and equity. It's not quite equity. It has other aspects to it. For instance, it doesn't have voting rights. But preferred equity tends to have a preferred dividend payment. But these equity holders are not really equity holders in the sense of having an influence on business decisions. So they are treated like debt. Now, preferred equity is not very common in some countries. It's more common in continental Europe in certain industries. And then you end up with the common equity value. So whenever you do a valuation, in the end, this is basically what you want. And once you have your common equity value and you know the number of shares outstanding, you can calculate a fundamental value. And then you can look at your fundamental value based on your calculation and the actual share price to have a discussion whether the company is under or overvalued. So that's the principle. Yeah. So again, here I outline the different aspects, but I already spoke about this. I just will go through this quite quickly. I think I mentioned all these different items in sufficient detail. Now, the final point I want to make in this section is around continuing value. Now, what does that actually mean? Now, the continuing value is the value of my free cash flows going way into the future. Now, in terms of valuation models, usually the forecasting horizon only covers a few years. So in a standard setup, you would have about 2, maybe 3 years covered by analysts' forecasts. Yeah, so analysts tend to write reports on larger companies. You would collect these reports and you would provide kind of an average view of the short-term period based on these reports and do some short-term forecasting for maybe 2 or 3 years. If you go beyond that, you would make assumptions about the value drivers of the business, and we talk about this more in another short video. You would do a forecast based on these assumptions for usually about 10-15 years. In total, the forecasting tends to stop after 15 or 20 years because, well, you run out of information, honestly speaking, quite quickly. Yeah? So that makes it quite difficult. But then, of course, well, the business would still have some value. The value would not be zero. So what do? So you make an assumption about what you call a continuing or terminal value, where you assume that, as a matter of fact, the business continues to grow in the long term and continues to have a certain level of profitability in excess of cost of capital. And as we discussed before, this is the precondition for value creation. Yeah, your return on invested capital has to exceed your cost of capital. Now, the core issue there is, what are reasonable assumptions for it? And the answer is, well, you would do some empirical research. And this will be firm specific. It will be also very industry specific. Yeah, we know certain industries, and we looked at the Kellogg example, you have quite high profitability, even over longer periods. But usually growth tends to be very low. Now, a long-term growth forecast should not be in excess of nominal long-term GDP growth. Why? Because otherwise this company in the long term would be the GDP, because in the long term it would simply dominate all other sectors of the economy, which is not plausible. So you cannot have a credible growth, long-term growth in excess of nominal GDP. Also an important note, anything we do in terms of forecasting is always in nominal terms. We don't try to adjust for inflation because we have no idea how inflation will develop. Of course, we can make expectations here, but the issue from a company perspective is inflation is affecting the business in very complex manners. Yeah, it's not straightforward. It's not the same compared to a consumer, because as a company, I have some possibilities to adjust, of course, prices, which of course then might again drive inflation. I derived here the exact formula for the continuing value, but honestly, it's not really that important. We just use it, and I can just, of course, show how this is calculated. But basically, the idea is simply to assume that you grow with a fixed growth rate and you still have a constant level of profitability. And then, of course, you can rearrange these equations then to express in terms of NOPLAT and ROIC, which we already calculated for the purpose of the valuation. And most importantly, this long-term value then has to be discounted with our discount rate, which again refers to cost of capital. The final part to note is we do some adjustments for mid-year and monthly adjustments. So what is the idea behind that? The idea is, of course, that it certainly matters when you do the valuation. Yeah? So if you are in January 2022 or in March 2022, the valuation should be considered differently, because then, of course, you're already a bit more in the future, so you have to be careful with your discounting. Yeah, because you are already 3 months in. The other issue is when do these cash flows actually occur? Yeah. Well, we don't quite know. So when you do a standard discounting, you kind of assume that the cash flow comes all in at the end of the period. But of course, that's not necessarily the case. Yeah, so what you tend to do is you tend to multiply this by a factor of 1 plus your discount rate to the power of 1/2, which basically means I shift everything into the middle of the period. Now, honestly, these adjustments, they are not massive. They don't make a huge difference, but it's good practice to think about this and to adjust your model accordingly.